Hey everyone, in today's video, we're going to be going through my $316,000 stock portfolio here. We're going to be talking about some stocks that I've been buying over the last couple months and just overall what positions I have in this account. So I hope you like this kind of content. If you do, be sure to give this video a big thumbs up. It really does help a ton with the channel, and consider subscribing too if you like it. So as you can see, this portfolio is up about 20% in the last year, over $50,000 in gains. Over the last handful of months, it's also been doing pretty well. $20,000 in the last 3 months, $7,000 in the last 1 month. Bit of a tough last week, down to about $1,700. But all in all, it's been a pretty good year for the portfolio here. Just going to go through, I'll talk some of these stocks a bit more in depth, but on the left-hand side here, you can kind of see all of my holdings. And I'm going to talk some stocks that I've been buying, how I feel about some of these stocks. Other ones I'm going to glance over pretty quickly just for the sake of time. So the first one I'll talk about here, Airbnb. Airbnb was one that I started adding a position into once it kind of crashed off a cliff here. It was at about 150, went all the way down to the teens. Looked at their business. I've owned Airbnb in the past, and actually, funny enough, have never really gotten the opportunity to build up a big position because it always kind of ran up as soon as I bought it. So I've bought and sold it a couple times, which really is not my style of investing. But it kind of happened to me again here. So I bought about a dozen shares or so in the teens, 112, 113, 114. As it drifted up to 115 to 120, I actually bought a couple more. But then it jumped to 130. So it went up essentially 10%. Before I really got to build a position in. So I'm still holding it, transparently hoping it goes back under 120, but don't really want to keep chasing it up 130, 133, 134. So this is just kind of a wait and see. It is one that I have bought a bit of, but I'm looking to make it a bigger position at a lower price point. If I'm not given that opportunity, it may be one that I just sell for the short-term gain once again, since I don't love having these like 0.3% positions in the portfolio. Going down a bit, you'll see lots of real estate companies. One of the more polarizing ones here is Allied. It's an office REIT. They, here, as I look over the last year, are now up 17% in the last year, but the bigger picture here is not very pretty. They used to be trading at around $50 a share. I kind of started chasing it down into the 30s, then it went to the 20s, then the teens. But it's had a bit of a resurgence here as interest rates have started to tick down. It was trading around $16, $15 here, and it went all the way up over 20. It's had some weakness over the last week, but it was in the low $20 range, which on $15 is like 30% increase on a REIT. In addition to the dividend yield I've been getting. So you can just see how interest rate sensitive some of these stocks are. I plan on continuing to hold. This one I've been getting about 9% yield on, despite, the overall position here still down pretty handsomely, 25% down on the overall weighted position on Allied. Continuing down, just kind of going through some of these other stocks I own, lots of royalty income funds, love the cash flow lots of these spit out. I've been moving more and more of my income funds, and I had a couple cover call ETFs that I've moved over to registered accounts for tax purposes, but I still do have some of them here. Just need to wait for more, RSP and TFSA room to free up so I can move those over and realize some tax efficiencies. But as I go through, lots of these are names I've owned a long time. Scotiabank, CapREIT. This stock here is one of the ones I just hold spare cash in. So as you can see, throughout the month, kind of just builds up, accrues interest, pays it out as a dividend. I was making about 5% plus, 5.2, 5.3% on these ETFs. But as interest rates have gone down, so has the yields on these. So I don't think this yield's accurate. It's probably closer to 4% in today's, interest rate environment. But before I was getting over 5, it may continue to trend lower. And the lower it trends, the more likely I kind of take some of this $15,000 and move it into other securities and investments, just because I don't want to be yielding like 1, 2, 3% on cash. Another stock that I've just kind of dabbled in, still a bit of a speculative buy. I'm doing more research, but Celsius Holdings. Can do another video on this one just so it doesn't take up too much time here. But they're obviously a very fast-growing drink company. But for a lot of reasons that I won't get into, in this video, the stock's absolutely crashed from over $90 down to 30. Overall, still risk, but I like the risk reward relationship on this one, especially just kind of still dollar cost averaging in. It's a super small position, not even $500. But as it continues to go down, or if it continues to go down into the 20s, we'd love to build this up into a bigger position. They're expanding in a lot of new markets. They have a lot of shelving opportunities in their core market, which is the US. And they also have an equity, or PepsiCo has an equity stake in them. So there's always a chance that PepsiCo can make a bigger investment or buy them out at some point. So that's a stock that I've been just nibbling on, just $500, but one that I have added to this portfolio, at least for now. Some of my other long-term holds here, CIBC has done super well. Taking a quick look at this one here. Over the last year, up, what is this, 60%? Wow, I didn't even know it was up that much. 60% in the last year, 25% in the last 3 months. I have a much bigger CIBC position in one of my other accounts, but here, up about 22%, just about a $2,500 position. Bought it pretty recently in this account too, and already up that 22%. CN Rail's been a more long-term hold across this account and other accounts, but it's kind of traded sideways over the last number of years. They revised their outlook downwards, which hurt the stock, but I don't really care. They buy back shares constantly, so at least I'm getting a better deal on those. And it's really a long-term core investment for me on that one. Canadian Utilities has been running up a bit. It was closer to $30, now at $35, so I like that. Continuing down here, Diversified Royalty Corp. This is one that owns lots of different trademarks. Think Mr. Lube, Oxford Learning Center, Sudden Realty Group. Mucho Burrito is one they just recently acquired, and they all pay either a percentage of sales or a set trademark fee into this royalty fund that then gets distributed to the shareholders, yielding 8.3% despite the little run-up we've seen here in the last year of about 18%. So this is one that I like a lot. I hold this one in a handful of different accounts too. Get a really nice dividend check every month, and it's actually been appreciating pretty nicely since I've owned it across my accounts as well. So I've gotten some capital appreciation. And for a dividend yield that's over 8%, they've actually increased it a couple times in the last few years, which has been kind of a nice surprise. They have some built-in increases on some of their contracts on their trademarks, so that's always great to have as well. Continuing here, big tech. The big tech stocks in my portfolio have really been probably the biggest source of capital gains, right? So Google here, you see up 45% in this account. I'm going to scroll down a bit. You see Meta here up over 450% on these 11 shares that I have here. So even though not a huge investment, the gain's already been over 5,000 US dollars. Then Microsoft as well, up 68%. So those three have done phenomenal. McDonald's here and Coca-Cola, both of these had some weakness when there was that whole Ozempic craze of no one's going to be eating junk food anymore, but it's really rallied back nicely, up over 20% over the last 3 months. Overall on this one, up about 30%, also getting a nice little dividend yield that increases every year as well. So like that, but these aren't stocks I've been buying. These have been kind of longer term holds I've had in this account. You can see here on Coca-Cola as well, up about 11% in the last quarter, 2.7% dividend yield. Have a pretty nice position here, 17,500 US dollars in this account here. Continuing to kind of go through the account, looking at some stocks that I've been buying coming up. But you can kind of see just these core, more dividend-paying stocks, Realty Income, Procter & Gamble, Restaurant Brands International. It's been going around a bit, but that's one that has been pretty stable. Rogers Communication, some recent news on them buying Bell's stake of MLSE, but that'll kind of be something that plays out over the next handful of years. One stock that's done really well, S&P Global, it's kind of gotten away from me a bit, so it's been hard to continue to buy it. When I was buying this stock around 370, 380, I remember thinking, oh boy, like this is an expensive multiple, expensive stock. Since then, it's gone up 35% in around a year, I feel like, give or take. So it just goes to show when you're buying really high quality stocks, sometimes you just have to pay up, but they still turn out being really great investments. So this is one that, you know, has kind of gotten away, probably won't add much more to it. but I like having this position here, and I do think it's a great business that'll do well even from here, over the long term once it has some time to breathe out. TD Bank, another big position. This one here has started to break out a bit. They've been just killed down because of regulatory issues, some lawsuits, some legal issues in the US, some acquisitions falling apart, just not executing very well overall. So as you see stocks like CIBC up 60% in the last year, TD's been a laggard, just up 8 or 9%, and all of that's just come in the last month or two here. Back in August, the stock was trading in the mid 70s. Now we're in the mid 80s, so about a 15% gain in just the last couple months here. With that being said, pretty decent sized position, $12,000. Only have about 3% in this account, but I've been getting a nice dividend yield, close to 5% on it. They've been increasing it every year as well, so I feel like I'll get another raise early in 2025. But this is once again another core stock that I've been buying for many years across many accounts. I love their commercial exposure. I used to like their U.S. exposure and just the opportunity for growth there. The outlook on that slowed a little bit, but overall, I think the Canadian banks, they're oligopolies and they're great businesses that trade at very fair multiples, in my opinion. And that gets me to the stock I've been buying the most over the last couple months, and it's been Uber. This was a brand new position, now at 54 shares or about $4,000 US. Would love to get this up to 100 shares over the short term here. This stock's really run over the last year, so I've been trying to buy it on dips, but it's been tough. Let's see what my average cost here is. About $67. Got some of it when it dipped into the 50s briefly. Should have loaded up on more, but hindsight's 2020. Long story short, I think their revenue growth profile is still really strong. And in addition to that, they've shown over the last handful of quarters that they can explode the bottom line disproportionately versus the top line. So they're kind of at that inflection point of reaching mass scale, expanding margins. They're cash flow positive, over $1 billion a quarter now. They're starting to buy back shares to dilute the equity grants they give employees. But over the next 12 months, that's going to move into totally offsetting those equity grants. And then hopefully by the end of 2025, they're going to be net diluting or net canceling shares and lowering the share base of the company to return net capital to shareholders. So really looking forward on just the profitability of this company improving, the revenue improving, and all that cash flow buying back shares. Hopefully all of those things serve as forces for growth in the total shareholder return in the stock price here. Okay, just moving quickly here. I know a couple of these ETFs here have just done fantastic over the last little while as international stocks have really rallied. This one here is primarily a Japan ETF. They've had some issues with their currency over the last number of years. We can just see here in the last year now up 18%. So doing pretty decent on this one, up 10% overall on my weighted position. Also get a 3% dividend yield. And that's a pretty new position. Then the second one, which is done even better because it has some China and Taiwan exposure, is the emerging markets ETF. So this primarily owns stocks from China, Taiwan, Brazil, India, I believe is the other big one, and then a couple percent in some smaller markets like Dubai and whatnot. But you can just see in the last year, this one's up now 27%, and it's just taken off in the last month, up over 11% in the month. So this one here have about $7,500 of market value in it, up 20% in it, and also getting that dividend yield as well. So overall, this one's been great for me so far. These are kind of long-term diversification hedges in other parts of the world that I kind of just like having more exposure to, since my portfolio is primarily Canada and the US. So I think this just serves as me not needing to go out of my way to find Canadian and US companies with good exposure to these markets if I just have these ETFs, and that's kind of the role they play. I also like getting those quarterly dividends. I reinvest them in other things as well. Wyndham Hotels and Resorts. This is one that I had been buying, but it did start getting away from me a bit over the last handful of months. I was buying it down here around 70, and it went all the way up to 80. Everything's been going up though, but I've still been trying to be disciplined. Looking at my cost basis here, 71, up about 10.5%, 2% dividend yield. I love how this stock this company rather really prioritizes returning capital to shareholders, pays 2% dividend, but also buys back a ton of shares. Company used to have about 100 million shares 5 or so years ago. Now they have 80 million shares, and just like last quarter, they bought back 1 million shares. So they continue to lower the share base, which long term will boost the EPS and hopefully reflect on the stock price in a positive way. So love those kinds of companies that are really dedicated to lowering the share base and creating value for their shareholders. Another ETF here that's done pretty well, ZDI. This is a BMO Canadian dollar ETF, but it is for international markets. So primarily Europe. Europe and Japan are the two primary areas that this ETF covers geographically, and it's all dividend stocks. So in addition to this 17% gain over the last year, I get about a 4% dividend yield on this. I'm up pretty nicely on this one because I started buying it years ago when the European markets had a lot of turmoil. So about 25% in addition to the 4 or 5% yield I've been getting on my cost basis as well. So it's been a pretty good investment so far. And then the last stock that I've been recently adding, very recently, this is one I've bought and sold a couple times, but would really like to add it in a bigger way in my portfolio. It is a big dividend, and I do have to pay the withholding taxes. So at some point, we'll try to move all of it into my RSP as well. But for now, just buying it here. It is VICI Properties. So you can see as the interest rate hike started happening, it really did blow up. So could have timed this one a bit better, but still getting over a 5% starting yield. They increase the dividend pretty nicely every year, so I don't mind that starting yield on cost. They also made about $2.55 in trailing 12 months funds from operation. So this one's trading at around 13 or just under 13 times earnings, which is definitely something that I can live with given their track record, given the quality of the assets they own. If you didn't know, VICI Properties owns lots of the hotels and lots of the land in Las Vegas. They're triple net leases. They have rent increases built in. They also own lots of land that hasn't been monetized. So whether they build on that, whether they rent that land out, whether they sell it, it should be other areas to other ways to monetize and increase that funds from operation per unit over time, just depending on how they allocate the capital they eventually get from those resources one way or another. So this is one that I like for the cash flow and just the stability of it. Hopefully, get that 5% out every year. But if interest rates continue to go down and down, I imagine the capital appreciation on this one has a good shot of being lucrative as well. So that was me just flying through the portfolio here. Let me know your thoughts on the portfolio. I know I didn't talk about all these names. It's stocks like Visa that's also done really well, AT&T that lately has just been flying. Let me know if there's any stocks specifically within the portfolio you want me to do a deeper dive on. But I just thought I'd jump on, do a bit of an update. Haven't done one of these in a while. And if you made it to the end of the video, thank you so much for watching to the end. Lots of people don't make it to the end, so I do appreciate it. Let me know in the comments. And once again, be sure to give this video a big thumbs up if you don't mind. It helps the channel a ton, and consider subscribing. Thanks, and I'll see you guys in the next one.